Today we're going to delve into the fundamental concepts of how money works. Whether you're new to personal finance or looking to refresh your knowledge, this video is for you. Number 1. The basics of money. Let's start with the basics. What is money? Money is a medium of exchange that facilitates trade and commerce. It can be in the form of cash, digital currency, or even barter in some cases. Money is the lifeblood of any economy, serving as a universally accepted means to transact goods and services. It simplifies the process of trade by providing a common measure of value. Imagine trying to barter for everyday items like groceries or a new smartphone. It would be incredibly cumbersome. Money makes our lives more efficient. The different forms of money have evolved over time, from shells and metal coins to today's digital currencies. Each form reflects the needs and technological advancements of its era. Cash remains tangible and widely used, while cryptocurrencies like Bitcoin have revolutionized the digital realm of finance. Understanding the concept of money is the first step to financial literacy. Whether you're earning a paycheck, investing in stocks, or saving for a rainy day, money plays a central role in your life. By grasping its basic functions and how it's created, you'll be better equipped to navigate the complex world of finance. So the next time you reach for your wallet or make an online payment, remember that you're participating in a system that has been refined over centuries to facilitate human interaction and economic growth. Money truly makes the world go round. Number 2, the history of money. The concept of money dates back thousands of years, from bartering livestock to using shells and coins. Over time, it has evolved into various forms, each with its advantages and disadvantages. The story of money is a fascinating journey through human history. In the earliest civilizations, people exchanged goods directly through a barter system, trading what they had for what they needed. This system had its limitations, as finding a mutual desire for goods often proved challenging. To address this, ancient societies began using commodities like shells, salt, and grain as early forms of currency. These commodities were durable, relatively easy to carry, and held intrinsic value, making them effective mediums of exchange. As societies grew more complex, coins made from valuable metals such as gold and silver became popular. These coins had intrinsic value based on their metal content, which added a layer of trust to the system. However, carrying large amounts of precious metals posed security risks. The advent of paper money and eventually, digital currencies marked significant leaps in the evolution of money. Paper money was more convenient than coins, and today's digital currencies offer unparalleled speed and security in transactions. Understanding the historical context of money helps us appreciate the financial systems we use today. It also underscores the importance of adapting to emerging technologies and the ever-changing landscape of finance. So, next time you swipe your credit card or make an online payment, remember the ancient origins of money that have led to the modern, digital financial world we now inhabit. Number 3, the functions of money. Money serves 3 main functions: a medium of exchange, a unit of account, and a store of value. Understanding these functions is crucial for managing your finances effectively. Let's delve deeper into these functions. Medium of exchange. Money acts as an intermediary in transactions, making it easy to buy and sell goods and services. Imagine if you had to barter or trade for every purchase you made. It would be impractical and inefficient. Money simplifies this process, allowing you to exchange your skills, time, or products for a universally accepted medium. Unit of account. Money provides a common measure of value, allowing us to compare the worth of different goods and services. This function makes it possible to set prices, create budgets, and track your financial progress. For instance, you can easily understand that a smartphone costs $500 and a week's groceries add up to $100. Store of value. Money allows you to save and store wealth. It's a means of preserving your purchasing power over time. However, not all forms of money are equally effective at this. While physical cash can be subject to inflation, certain investments like bonds and precious metals may serve as better stores of value. Understanding these functions helps you make informed financial decisions. You can use money not only for daily transactions, but also for setting financial goals, budgeting, and building your wealth. Whether you're planning for a major purchase, investing in assets, or simply managing your day-to-day expenses, money's functions are at the core of it all. It's essential to recognize how these functions work together to empower your financial future. Number 4, how money is created. Have you ever wondered how money is created? In modern economies, money is typically created through a process known as fractional reserve banking. I'll break down how this works. Fractional reserve banking is a system used by banks and financial institutions to create money beyond the physical currency in circulation. Here's how it operates. Deposits. When you deposit money into a bank, you're essentially giving the bank permission to use a portion of that money for various purposes. The bank is required to hold a fraction of these deposits, hence fractional reserve, as reserves, typically mandated by the central bank. Lending. The bank then lends out a significant portion of your deposit to borrowers, such as individuals or businesses, to earn interest. This newly created loan amount becomes a deposit for the borrower and can be used for various purposes. Multiplier effect. This process continues, with the money being redeposited and lent out again, effectively creating a multiplier effect. For example, if you deposit $1,000 and the bank has a 10% reserve requirement, it can lend out $900. The borrower then deposits the $900, and the bank can lend out $10 and so on. This system can significantly increase the money supply, stimulating economic growth but also carrying risks, such as potential bank runs or economic instability if not managed carefully. Understanding the process of money creation is essential to grasp how monetary policy and banking practices can impact the overall economy and your financial situation. Number 5. The time value of money. Time value of money is a fundamental concept in finance. It's all about understanding that money today is worth more than the same amount in the future. I'll show you some practical examples. The concept of the time value of money stems from the idea that $1 today can be invested or put to use, earning a return or generating value over time. In contrast, $1 received in the future is subject to inflation, opportunity costs, and uncertainty. Consider this scenario. You have $1,000 and you have two choices. You can either spend it today or invest it at a 5% annual interest rate. If you choose to invest in 1 year, you'll have $1,050. But the time value of money is not just about understanding investment returns. It's crucial in various financial decisions, from budgeting and saving to making major life choices like buying a home or planning for retirement. Here are some real-world applications. Budgeting. Understanding the time value of money can help you allocate resources efficiently. You may prioritize paying high-interest debts before they accumulate more interest. Investing. When investing, you're considering the future value of your investments. The earlier you invest, the more time your money has to grow. Retirement planning. Saving for retirement is a classic example. By starting early and letting your investments grow, you'll have more to enjoy in your golden years. By recognizing the time value of money, you can make better informed financial choices that align with your goals and priorities. This fundamental concept underpins a wide range of financial calculations, including net present value, future value, and annuities, all of which are crucial in managing your financial well-being. Number 6, inflation and its impact. Inflation erodes the purchasing power of your money over time. We'll discuss what causes inflation and how it can affect your financial goals. Inflation is the gradual increase in the prices of goods and services in an economy. It's a natural phenomenon in any growing economy, and it has a significant impact on the value of money. Here's why understanding inflation is crucial. Purchasing power erosion. When prices rise, each unit of currency buys less than it used to. For example, if your monthly expenses increase by 2% due to inflation, the same amount of money you had a year ago won't cover those costs today. This means your money's purchasing power has diminished. Savings and investments. Inflation can affect your savings and investments. If your returns on savings or investments don't outpace inflation, you may be losing money in real terms. It's essential to invest your money in ways that have the potential to outpace inflation. Financial goals. Inflation can impact long-term financial goals like buying a home, sending your kids to college, or retiring comfortably. You must account for inflation when planning for these milestones to ensure your money grows enough to meet your objectives. Several factors can drive inflation, including increased demand for goods and services, production costs, and monetary policies by central banks. By understanding the causes and consequences of inflation, you can make informed decisions about saving, investing, and setting financial goals that account for the rising cost of living. Number 7, saving and investing. Now that you understand the basics of money, let's talk about how to grow it. We'll cover the difference between saving and investing and why both are essential. Saving and investing are two distinct but interconnected financial strategies, each with its unique purposes. Saving. Saving involves putting money aside, often in a savings account or other low-risk, easily accessible instruments. Savings are typically used for short-term goals or to build an emergency fund. While savings may not generate substantial returns, they provide liquidity and security, ensuring you have money available when needed. Investing. Investing involves putting your money into assets that have the potential to grow over time, such as stocks, bonds, real estate, or mutual funds. Investments aim to generate higher returns, making them suitable for long-term goals like retirement or wealth accumulation. However, they come with varying levels of risk and should be aligned with your risk tolerance and financial objectives. Balancing saving and investing is critical for financial success. Saving provides a safety net for unexpected expenses, while investing offers the opportunity for your money to work for you, potentially outpacing inflation and helping you achieve your long-term financial aspirations. Number 8. Budgeting and financial goals. Creating a budget and setting financial goals are crucial steps in managing your money effectively. I'll walk you through the process and provide some useful tips. Budgeting. Budgeting is like creating a roadmap for your financial journey. It involves tracking your income and expenses to ensure you're living within your means and saving for your goals. Here's how to get started. Track your income. Begin by listing all sources of income, including your salary, side hustles, and any passive income. Identify expenses. Categorize your expenses into fixed, rent, mortgage, utilities, and variable food entertainment categories. This helps you understand where your money is going. Set financial goals. Establish short-term and long-term goals, such as paying off debt, saving for a vacation, or building a retirement fund. Create your budget. Allocate specific amounts to each spending category based on your income and financial goals. Make sure your expenses don't exceed your income. Financial goals. Financial goals are the milestones you want to achieve with your money. They provide a sense of purpose and direction for your financial decisions. Consider the following. Specific goals. Your goals should be clear and well-defined. For example, instead of saying, "I want to save more," specify, "I want to save $5,000 for a down payment on a house," short-term and long-term. Differentiate between short-term, less than 1 year, and long-term, more than 1 year goals. This allows you to prioritize and plan accordingly. Regularly review and adjust your goals as your circumstances change. This ensures they remain realistic and attainable. By creating a budget and setting financial goals, you gain control over your financial future. You'll make informed spending decisions, save for the things that matter most to you, and stay on track to achieve your dreams. We've covered a lot, from the history of money to its functions, inflation, and practical financial strategies. Remember, financial education is the key to achieving your financial goals and securing your future.